Financial analysis. Viability of purchasing Dr. Fiddle's practice for Stronger Memorial Hospital. Prepared by myself, Leanne Frame, for Don DeRusso. Does the practice generate enough cash to cover its current obligations? Liquidity ratio is the ability for a company to meet financial obligations, which can be met by converting liquid assets to cash. It is better to have a greater level of coverage of assets to liabilities. A current ratio of 1.0 is an indicator that the practice is doing well to cover short-term liabilities. Although both years show a ratio of greater than 1.0, we need to analyze the type of assets the practice has and how quickly it can be converted to cash. We also need to analyze how long it takes the practice to collect on services. Quick ratio measures the most liquid current assets that can be converted to cover current liabilities. Quick ratio is more conservative than current ratio since it excludes inventory and other assets that are not as easy to turn into cash. As with current ratio, a quick ratio of 1.0 means that the practice can meet short-term obligations. By looking at the trends of both current and quick ratio, it may be an indication that the practice is having difficulties collecting its accounts receivable. As we look at our key ratios, current liquidity and quick ratio has trended worse comparing from one year to the other. If the downward trend continues from one year to the next, the practice will not be able to cover financial obligations. Is the practice likely to be able to meet its long-term obligations as they become due? Debt management ratio tells whether the practice can meet long-term obligations. When looking at the key ratio analysis, we see that although the debt to total assets remain the same from one year to the next, we see a huge decline from 2013 where the debt could be paid 26.5 times over as compared to 2014 at 1.19 times. We would prefer to see higher ratios since this shows that the practice can afford to meet long-term obligations when they become due. Lower interest ratios may indicate credit risks. Is the practice increasing its patient encounters and collecting its accounts receivable in a timely manner? For inventory turnover, the higher the turnover ratio, the better, as it indicates the practice is collecting on its accounts receivable sooner. Comparing both years, we see a decline. We also see a decline in trends of average collection time, a difference of approximately 28 days. Total assets turnovers show us a large decline from one year to the other, which may indicate that the practice has not been very productive in managing all their assets to generate income. What is the practice's net worth or equity, and is it improving? And is the practice improving its profitability at a sustainable basis? Net worth is the amount by which assets exceed liabilities. As seen in the liquidity key ratio, the trend is worse on both current and on quick ratio. It has not seen an improvement from 2013 to 2014. Profit margins measures the practice's profitability at various levels, and the margin may shrink as additional costs are included, such as cost of goods or taxes paid. Return on assets shows us the practice effectively uses their assets to generate profits. Return on equity tells us about the ability of the practice to earn on investments. Although the profitability trended better from 2013 to 2014, there was a huge significant loss of net income in 2013 due to investment income coming in well below the expenses. The return on equity from 2013 to 2014 is 6.3%. An equity ratio of 15 to 20% would represent a good investment. At 6.3%, the practice is not improving fast enough on a sustainable basis. How might the hospital's acquisition of Dr. Fiddle's practice impact the future financial performance of the practice itself? If Dr. Fiddle's practice is acquired by Stronger Memorial Hospital, the practice may receive higher Medicare payments for some of their procedures. Medicare payments to hospitals have not been cut compared to payments to private practices. And also, if acquired, Dr. Fiddle will get a regular salary and lessen the unpredictability of changes in healthcare laws. And also, it may clear any of Dr. Fiddle's outstanding debts. All factors considered, do you think it's a good idea for the hospital to acquire the practice? At 6.3%, the practice is not improving fast enough on a sustainable basis. Liquid ratio and asset management ratios are also both on a worsening trend. Although the profitability is trending better, profit margin is at 0.3% for 2014. Generally speaking, 25% is considered favorable. Dr. Fiddle's practice was not lucrative, with a non-operation gain for 2014 due to a one-time insurance distribution by the FDIC, and also Dr. Fiddle took a voluntary pay cut in 2014. Part of the income comes from a sublease of an office space. After analysis, I do not recommend acquiring the practice.